Correct. Hello, everyone. Welcome to another episode of the Oil Investor Podcast that aims you to equip you with the right knowledge to make your decisions with respect to investments. My name is Yashwanta, and I'll be your host today. And today, I'm delighted to welcome Samir Bhandari, who's the co-founder and CFO of hBits, a fractional real estate platform. Samir has worked in various institutions like Bank of America, UBS, JP Morgan, and in his last role, he was the MD and co-chair of sales globally at Nomura, based out of Singapore. I'm really excited about this podcast as Samir has a wealth of knowledge in the financial domain. And, if I was in my corporate career, I would tell someone to get a coffee with a person like Samir. So I'm personally looking forward to learn from him a lot in this podcast. And it's my absolute pleasure to have you, Samir, on the show. A very warm welcome. And thank you for doing this on a being day.
Thank you, yes, so much for having me.
Thank you. How are you doing today, Samir? I realize you're based out of Sydney, so it's late, but appreciate taking the time.
No, thank you. I'm actually based out of Singapore, just
That's right.
traveling to Sydney for the week.
Right. So, Samir, let's get into it. 34 years in banking and then hBits, 2 years journey. Why did you make that switch?
So, firstly, let me just talk a bit about why I took banking.
Yeah.
I did my chartered accountancy and then passed out from my MBA, IIM Ahmedabad in 1989. I have always wanted to be in banking. I mean, that was my career choice.
And is that because of the money?
Well, to be honest, one was definitely that.
Right.
I wouldn't deny that. But banking, I just thought that I could use my chartered accountancy knowledge, my MBA in finance and marketing. Actually, I could learn. So that was very, very important to me. And I said, I want to get into a career which I don't only like, but I love. Because then when you talk about work-life balance, if you love your work, then that becomes your life. And that was very, very important to me. So I took up banking from the beginning, worked there for 34 years, loved every day. I worked in 4 very beautiful, fantastic institutions amongst, so Bank of America, I worked in Mumbai and Hong Kong. I worked in UBS in Singapore. I worked in JP Morgan for 9 years in Singapore. And last but not least, Nomura for 13 years in Singapore. Loved every day. Every day I would get up and want to go to work. And that kept me going. When I lost that spark in December 21, I decided time has come to move on. And that's when I retired from banking after 34 years. Then the question for me was, what next? What should I do? And there were 2 or 3 choices. One is, fortunately, banking pays you a reasonable amount of money. So I could have decided I don't want to do anything. That was always one option. But then, when people are looking at longevity today, people are living till 90, 95, you at least want to work till 75 or 80. And that was one of the reasons why I said, okay, let me do something which is very interesting. Now, property for me as an asset class has been roughly 50 to 60% for my overall portfolio. And fortunately for me, Yash, I've done really well. So I have homes in Singapore, New York, and India. And most of the time, the timing has been very good. So that's actually worked out really, really well for me. I wanted to do something around the technology world because obviously when I retired from banking, I was not a tech person. So I needed to learn a bit around that. So said, can I combine property and technology and do something around the prop tech world? And I was looking at different options. And when Shiv came along, so Shiv pitched his business to me.
Right.
I liked the concept, and I said, okay, you know what? This is something which really interests me, where I think I would love it if I get into it. Because as I mentioned earlier, Yash, it's all about loving what you do, right? I don't want to do something I like. I want to do something which I love, because then I can give as much time as I want, and there's no question of work-life balance because you're loving your work there. So that's when I decided to get into hBits. Initially joined as CFO, And then within a year, Shiv and I got along so well. Then Shiv said, why don't you become also co-founder and
Right.
accelerate growth for us?
Hmm.
So that's really the thought process I had. And I'm loving every day. It's been almost 2 years. I'm going to finish in June. I'm loving every day working with hBits.
Great, Samir. Can I ask, how did you and Shiv meet? Like, how did you get introduced?
So very interesting. Firstly, he was introduced through a common friend.
Right. Okay.
And he was actually pitching his business to me.
Right.
Initially more as an investor.
Right. Okay.
And I actually liked the concept, and that's why I was.
Right.
And even if I had not joined him, I would have definitely invested in his business. I still remember the day. I was in the US when we had this conversation, and everything clicked well. I went to India to meet him. That was a great conversation we had. We had very common goals, what we wanted to achieve, and it really worked well. And so far, it's been fantastic.
No, amazing. I mean, a success for a startup is primarily also down to the cohesiveness of founders and the understanding, mutual understanding, right? So that's amazing. Um, You mentioned that you have 65 to 70% of your portfolio in property, which is kind of astonishing to me because a lot of, I would say, influencers or people advise you not to invest in property or, your residential homes or whatever. What particular things did you look at to, let's say, get ahead of that curve and do exceptionally well, like you said?
So I think, yes, a few things are very important, right? One is the timing of that decision. So I was very fortunate. And let me talk about timing, say, in Singapore. Singapore, I bought my first property around 2005.
Okay.
And that was the time when the casinos were just about coming up.
Okay.
And I took the view that Singapore's actually going to change. The skyline is going to change. And this is the time to get into it. And fortunately for me, since I've gotten, I mean, the property prices are up almost 4 times. So that's helped. India, as you know, the pre-Modi government, real estate did actually extremely well.
Okay.
And if you had good timing, if the location of the property was very good, you actually did extremely well. Plus, I think luck plays a very important part. Yash, without luck, I mean,
Of
you
course.
can keep trying, but nothing really works. So I think a combination of these three. So I've been in a way very lucky also, and fortunately, a lot of my wealth has been created with property.
It's amazing. Amazing. Some lessons from my father to learn there. The family. Okay. Can you explain what is hBits and what are you trying to achieve via hBits?
So let me talk about first what is hBits.
Right.
We are a platform which democratizes real estate
Okay.
or fractionalizes real estate.
Okay.
So we give an option to the normal person or a retail investor to own a fraction of commercial real estate. And why commercial real estate? For 2 reasons. One is it gives passive income of 8 to 9%. And secondly, it gives capital appreciation of typically between 6 to 7%. And you can be very certain about that because commercial properties sell on cap rates or rental yields. So unlike residential, which the rental yields are very low, or unlike holiday homes, which basically sell on sentiment, commercial property sells on cap rates, rental yields. And that's what we try and bring to an investor. An investor as an alternative investment, which gives you returns of 15 to 16%. Plus, on the other side, on the supply side, we are also helping developers exit some of their properties. And that was one of the genesis of why hBits was really formed. We wanted to help our retail investors participate in this asset class, which is extremely lucrative. And we also wanted to help our developers in India to exit some of their properties. Because either they could exit the whole building to Blackstone or Brookfield, which obviously buys 1,000, 1,500 crores, or they could go to a high net worth individual for 20, 25 crore asset. Here we've created an asset class from anything between 25 and 500 crores, which we give access to the developer and to the retail investors. Also, Yash, I feel this asset class, if you compare to any other asset class, let's compare it to fixed income. Fixed income gives you returns of 7 to 8%.
Correct.
Equities over large periods of time, or long periods of time, I would say, especially large caps, give you anything between 13 and 15%.
Correct.
Commodities, if you see as an asset class, gives you anything between 7 and 8%. Again, long periods of time I'm talking about.
Correct.
Commercial property, actually, if you can hold it for 4, 5, 6 years, can actually give you returns of 15 to 16%, which are in fact a lot better than a lot of these other asset classes.
Interesting. Within 4 to 5 years, you say?
Yeah. The holding period should be, we advise at least 4 to 5 years. And beyond that, definitely IRRs you can expect of 15 to 16%.
Interesting. Do you feel the fractional ownership plays now, the play in India is kind of heating up right now with so many new players entering into the picture? And do you feel the heat of the competition at HBits?
Yes, I feel this business, the barriers to entry are extremely high.
Really?
And I'll give you yes. And people don't understand this, but there are reasons for it.
Okay.
Firstly, let's look at the supply side. When you're identifying properties, when you're deciding which micro market you should be investing in, whether it's the right building you're buying into, I think that requires a lot of domain knowledge. People feel that they have the domain knowledge, but I can assure you, being now so involved for the last 2 years, it's not easy. So that is one. Secondly, acquiring investors and having investors to trust your platform takes time. I mean, Shiv started this company in 2019. I joined him 2 years back to accelerate growth. But he has been at it for almost 4 to 5 years.
Correct.
And that's how we've actually built the brand. That's how we've built people wanting to trust us. So I'm actually, honestly, Yash, I think there'll be 2 or 3 players left in this industry. And a lot of the others will start doing probably some other things. So I actually don't see competition as such. I think we compete against ourselves. Like we are at 365 crores of AUM. We want to be at 1,500 crores of AUM this year. So we are competing against ourselves to acquire more properties, to increase the velocity of sales, making sure we get new investors in, making sure we educate the investors in. And with SEBI now regulating us, obviously a lot of wealth firms also want to distribute our product.
Yeah.
So I think we are going to compete against ourselves. And the market is so large, it's not winner takes all, right? There'll be space for 2, 3, even more players if necessary. But I do feel very strongly that barriers to entry for this are extremely, extremely high. It's not like selling a mutual fund. It's very, very different. Selling a mutual fund, anyone can do it. Selling cash equities, anyone can do it. But selling property, it's not everyone's cup of tea.
Got it. You mentioned SEBI regulating you. Can you talk about that regulation?
Yes. So SEBI on March 8th formally said that they would be regulating us. They call it the MSM REIT. This actually is a very, very welcome sign for us. Now the product is kosher. It's got the stamp of approval from SEBI. All the units are going to be listed on the exchange. The sponsor would have to have 5% skin in the game. And 20 crores minimum capital which would be required. The minimum ticket size would come down from 25 lakh to 10 lakhs. But the beauty is because it's going to be traded on the exchange, the liquidity definitely will improve. Right now, if someone wants to exit, we don't have any issues around exit. They can exit anytime, but this takes around 30 to 45 days to exit. But once you are listed on an exchange, obviously liquidity becomes a lot better. And we'll be regulated by SEBI, which again is very, very welcome.
Interesting. But before I come into questions related to this regulation, because I'm very curious and talking to other players, I've figured that there might be some gaps which people are still seeking clarification on. Can you also explain to the viewers what is a REIT per se?
So REIT is, if you expand, it's basically a real estate investment trust.
Correct.
It's a trust which buys properties. And in the traditional REIT, globally, if you see, they buy commercial buildings. They typically would leverage the REIT. Most of the players leverage 40 to 50%. And they then, any income which they get from the commercial buildings through rental, 90 to 95% is distributed to the investors. REITs are typically listed on the exchange. Two things which impact REITs. REITs trade like equities.
Okay.
So when, and this is globally I'm talking about, when equity prices go down, REIT prices typically will go down. Also, REIT prices get affected by interest rates.
Right.
So as we've seen interest rates going up, REIT prices obviously have got affected. And let me talk a bit around the US, since we are talking about REIT. US REITs have got decimated. There are REITs which are down 50%.
Wow.
And there are REITs which are down 80%.
Interesting.
And there have been 2 or 3 reasons for that. One is, of course, the work from home culture in the US. I mean, except for the East Coast and the bigger, larger cities like New York and Boston and some of the larger cities, where people are coming back to work. In the West Coast and Middle America, most of the people are still working from home. So you have a lot of vacancy in commercial buildings. So that's one. All the REITs were borrowing at 1 to 1.5% till 2-3 years back. And they were levered up 50% at least. Now they are paying 6% interest. So that's gone up by 4 to 5 times. And they are not, and people are giving up commercial property because people are not coming back to work. So it's basically just double whammy. You don't have tenants, interest rates have gone up, and hence a lot of the people, in fact, are giving their keys back to the lender and says, why don't you go and sell it? And property prices are down 50 to 80% in the US. In fact, I don't know whether you know, a lot of large players like Blackstone also have actually defaulted on some of their properties or SPV, specific to certain SPVs. So that's what happens in REIT. If you come to India is slightly different because Indian REITs are related to a lot of the developers. So Embassy will have a REIT, K. Raija will have a REIT. There the liquidity is not as much as the US markets.
Right.
And in India they allow 20% under construction.
Right.
And obviously leverage is allowed. So the REIT market in India is still in a very nascent stage. So I would say one should look at actually the US markets because that's probably one of the most mature markets in the REIT space. The Singapore market is also very, very mature. And Singapore REIT prices are behave a lot like the US. The difference there is that in Asia, again, everyone has come back to pretty much work. Whereas in the US, people are still working from home. I hope that answers the question, Yash.
So if it's now with SM REIT coming into the picture, I am assuming you're going to apply for that license rather than the REIT license, which has a 500 crore minimum requirement of persons.
Yes. So we are in the
Hmm?
process. We are talking to our lawyers to apply
Right.
for the SM REIT license. You're
Right.
absolutely right.
For SM REITs, let's say if you can hold 50 crore worth of assets in an SPV and you list it on an exchange, do you need a merchant banker or investment banker to help you get listed on the exchange?
So yes, that's what the regulation says,
Okay.
that a merchant banker has to be appointed,
Right.
and effectively you need to do it like an IPO.
Right.
So even if you list a 75 crore REIT, you should appoint a merchant banker.
Right.
You should go through the documents. You should file the documents with SEBI. SEBI then gives approval, and then you get the money. But obviously, there are practical issues around it, right? Firstly, sellers want their money within 60 days. So if SEBI takes more than 60 days, how do you start taking the money in? That's one. Appointing a merchant banker is absolutely fine. But typically, merchant bankers get money from institutions. They don't collect from retail. We have the distribution for retail. So merchant bankers can then help in the documentation. So that could be there. But these nuances still are being discussed with SEBI.
Yeah.
Our founder had met with SEBI and they've been discussing these things.
Right.
And making sure that you don't have issues around it. And I'm sure the SEBI understands these things. And they'll come up with some nuances which can practically solve these problems.
Now, the point I was coming to add is you will have to pay this merchant bankers, right? And I assume it's at least 2 to 3% of your overall asset size because these people are also remaining money. And when you have to pay that 2 3%, your margins shrink, or either the investor has to pay for it, something like that. So it's, I mean, my assumption is that the yields that you're offering in FOP structure right now might go down when you have to do it by the SM REIT structure because of the added compliance cost and merchant banking cost and all that stuff. And you would agree to that, right?
No, absolutely. So very, very fair observation. Yash, it's I would just say it's early days.
Yeah.
Obviously we're going to negotiate with the merchant bankers.
Right.
We want to make sure that our investors get the best returns.
Yeah.
Because that's why they're coming to us, right?
Yeah.
Our cost structure is lower. That's what we like to do. And that's why I think it also becomes imperative over time. You'll see that sizes will increase. So 50 crores, instead of doing 50 crores, we might do 150, 200 crores.
Correct.
And bring down overall costs so that the return to the investor is still the same or higher. But like I said, I think it's going to evolve. Yash. I think it's a question of, give it 12 months, 18 months, 24 months, it's going to be different. And as the mutual fund industry evolved over time, this will also evolve. I just feel this will be much faster because the mutual fund industry took a long time. This, I think the timing will just compress and you'll see it evolving very quickly.
I think the SEBI chairperson is also very bullish on this segment overall.
Madhvi is very, very bullish on it. In fact, I've seen her videos also, and she's encouraging people to invest in these alternative investments.
So coming to investors, which type or what type of investors should invest in these kind of opportunities? Why should they have, let's say, fractional ownership or REIT in their portfolio?
So, let me take a step back, right? Let's talk about where do investors put in money, right? Okay. Investors put in money in fixed income products.
Right.
And when I say fixed income products, it can be fixed deposits in corporates. It can be fixed deposits in banks. Right. It can be corporate bonds across various credits. So it can be a AAA corporate bond, AA, single A, whatever your risk capital. Then you have people who put in equities. When you talk about equities, you put in cash equities, where you directly invest in shares of some companies, or you go through the mutual fund route, right? Because you say, okay, the asset manager has the expertise, I'll give it to them. Then thirdly, what's also happening is you have the alternatives space. Now, alternative space can be AIFs, can be now SM REITs, can be a structured credit fund, or it can be something else, right?
Yeah.
But anything to do with slightly different nuances as compared to the other products.
Yeah.
I always feel, and personally also I can tell you, I also have money in alternates.
Right.
And when I talk about alternates, like I have invested money in the hBits platform also, because I also wanted to see how's the platform, right? So effectively personal skin in the game, not firm, but personal skin in the game. So that I understand it. Whether it works properly, whether I'm getting my rental income, everything. So that's one. So how I would say, look at as an asset allocation. If you have 100 rupees, and depending on your age, you decide where to put it. People who are older, I think, need passive income. And they are more skewed towards fixed income, to some extent alternative products. If you're younger, you can be more aggressive and you can be more into equities.
Yes.
But on an asset class basis, if I was to say, if I had 100 rupees, where would I put in alternates? I mean, as you know, Yash, I mentioned my real estate portfolio is so large, right?
Yeah.
And fortunately for me, I made reasonable amount of wealth around that.
Yeah.
So I'm now switching personally from residential, switching from holiday homes into a lot of these alternates, which then give me a good passive income of 8 to 9%, and can give me IRRs of 15 to 16%. And that's what I'm doing. Yeah. So I would say anything between 10 and 20% you could have in alternates. And depending on the wealth, right? If you're worth 10 crores, you can say, okay, I want to put more. If you're worth 1 crore, maybe less. If you're worth 100 crores, maybe you can do more. It also depends on your overall wealth. But I would say anything between 10 and 20%, do look at alternates.
I mean, this corroborates. So basically, I run a WhatsApp community on alternative investments, and we have roughly around 850 participants in it. I recently ran a poll as to how many of you have how much of your portfolio in alternatives, and you won't believe around 37% participants say they have more than 30% in alternatives right now. But that's not only real estate based alternative, that's also things going on like invoice discounting or lease based financing and SEIs, which are also picking up quite quickly in the market. But it's an interesting area. People are genuinely curious, I would say, as to, I want to make the best buck out of my money. But it's also confusing to a lot of people because there's a lot of awareness work that needs to be done as well. Spaces are confusing. So that brings me to my next question. So there are, I think, so roughly about 10 to 15 years right now in this fractional ownership piece. I know you said only 3 or 4 will survive the test of time, but within those 15, 20 years, why hBits? Or, rather, not only hBits, but if somebody as a retail investor has to choose which platform to go well, what should they look at?
So I would say, and I won't even sell hBits because I know what we are. But I'll just tell you what investors should look at. One, do look at the management team of the organization. I think it's very, very important. That's first. Secondly, firstly, also see how long have they been in existence. That's, I think, in a way, it's important. Thirdly, the properties which they have been bringing onto the market, how have they actually done in terms of mark to market?
Is that data available publicly?
I mean, data is available publicly. You should be able to get it. Like, for example, hBits, if someone asks us, all our properties, where's the valuation? We can provide the valuation.
Okay.
And these are independent valuers. And this is what SEBI is also going to say, right?
Yeah.
Because how is it going to trade in the listed market unless you have valuation?
Right.
So that, I think, becomes, again, very, very important. And I think, fourthly, just look at the platform, right? I mean, look at some of the credentials which people have. How's that done? When you want to exit, have you been given exit? And these are some of the things which you should look at. But I think two most important things are, one is the management, and one is look at the mark to market and how the properties have actually done, which basically means how are these people actually identifying the micro market? Are they spending time there? One of the reasons we are very, very careful and not very aggressive in keeping acquiring is because we want to acquire the right properties. Yes, that's very important.
Okay. And how frequently does one need to do this independent valuation of the property?
So we just do it yearly.
Okay.
I would ideally like to do it 6 monthly.
Okay.
Because I don't think property prices change so much.
Right.
But definitely 6 monthly would be ideal, I would say. And I would at least urge my organization to start doing that.
Okay. And I think so the SM REITs regulation say it to be done yearly, if I'm not wrong.
That's correct. That's correct.
Yeah.
If you do it 6 monthly, it's great, right? It's only good for the investor. So at least I would like to try and do.
Sorry, it might be a stupid question, but let's say the 10 lakhs requirement in SM REIT. So will it listed in the denomination of 10 lakh rupees on the exchange, or will it be fractionalized even more? Only the pre-IPO will be done as 10 lakh rupees.
So initially, I think, Yash, it will be listed as a 10 lakh.
Oh, okay.
But over time, as the chairperson also mentioned, she wants to get it to 1 lakh, right? So over time, the denomination will change.
Right.
I think initially it will be listed as a 10 lakh denominated instrument. And it will be in demat form.
Right. So the liquidity might not be that great at a very start, but hopefully in next 2, 3, 4 years, it should start picking up.
My guess is in 18 to 24 months, Yash, liquidity will pick up a lot.
Okay. And can you, let's say when you create a REIT, can you add more assets into it? At a platform level? Or what do you need to do from an exchange? Because that REIT is already listed on the exchange, right? So how does it work? Or does the investor need to provide more money? Something like that.
So great question, Yash. So it's going to be, the REIT is going to be listed as a trust and it will have different schemes. So every scheme will be one unit, right? So suppose I acquire a 100 crore building. That will be scheme 1. That will be listed as scheme 1. Then scheme 2, then scheme 3, then scheme 4. And investors can buy or sell different schemes.
Okay.
So it's going to be listed as different schemes initially. And then, of course, you could combine it overall as if it becomes 5,000 crores, you could list it as a REIT if you really want to. But these will be different schemes listed in the SM REIT. One of the things, Yash, I feel people should compare this instrument to other instruments. So firstly, you should compare it to fixed income, right? This instrument is a triple A instrument. If your tenant is triple A.
Okay.
Like in our case, we've launched a property in Pune. Its tenants are Air Products, which is a $55 billion company listed on NYSE. And then you have Amdoc, which is traded on NASDAQ, which is a $10 billion company. If you were to rate these tenants in India, you would get a AAA rating. So effectively, your instrument becomes a AAA instrument because the rental which is being paid by these two tenants. So 8 to 9% rental income plus benefit of capital appreciation. Capital appreciation, pretty much, I wouldn't say it's guaranteed because that's a very wrong word.
Yeah.
But it's a given that if you will get anything between 5 and 7% because rental escalation is typically 5% per annum.
Wow.
So that gets basically into the asset prices as after 4 or 5 years. So when you sell, you will sell at pretty much the same rental which you got in today.
Yeah.
Not assuming that interest rates have remained the same.
Right.
If interest rates go down, you get even more compression.
Right.
So this is an asset class which you can easily get between 14 and 16%. And compares a lot better equities, fixed income, commodities. The only disadvantage today, it's not a very liquid instrument, right? If you were to exit, it might take 30 to 45 days. So that's the liquidity premium. That's it. But as an asset class, commercial, if done well, is actually amazing. And can you imagine a AAA asset, you're getting effectively 15-16%? Not, not any, I mean, invoice discounting when you do, these are all triple B names, double B names. Then you have secured credit, right? I mean, you can have single B, double B names also, which is why I think people should understand this. And which is why I think people are starting to understand a lot more, and people are treating it more as a financial instrument,
Right.
rather than as real estate.
Okay.
And as it becomes more and more liquid, it effectively becomes a financial instrument.
Interesting. From HBits perspective, given you have this 2 years as a co-founder or as the CFO, at least, what do you think is the primary challenge or can be a primary hurdle for HBits to grow even bigger or let's say meet your targets of 1,500 here?
So the only challenge I would say is, so acquisition of property is not a challenge.
Right.
There are enough of it. We're getting enough of it. Acquisition of investors is very important. And that we are doing through branding, marketing, salespeople. We need to increase the velocity of sales, right? Which is what we are doing. Say if we are doing 2 crores a day today, I need to do 4 crores a day.
Correct.
So that's how you grow.
Right.
And I wouldn't say it's a challenge. It's a process. And processes take processes.
Because they need to
Exactly.
build trust, right? Trust is the main thing here.
And which is what we are really trying to do, build trust, which is why I personally get involved with investors, talking to them, what I believe in. Personally, I put in money to understand the process. And that I think is very important. And it's trust you build over time. Trust is never built in a day.
Absolutely agree. Because you talked about acquiring a property is easier, or at least you have it figured on your side. Might be an appropriate question to ask, but is there still a concept for black money, commercial properties, and you have to deal with these kind of things when you're doing the due diligence?
No, we don't have to deal with it. Firstly, because we don't take that at all.
Right.
So we don't even discuss that.
Right.
We have not come across, and I think people have moved away from it completely, especially around the commercial space. Maybe in the resi space, maybe it's there, or holiday homes, maybe it's there. But commercial space, a lot of it, especially in the larger cities, people have moved away from it.
Right.
So we don't have to deal with it at all.
Okay. And within the commercial space, are you targeting any particular pockets like warehouses or data centers or something else like offices?
So offices we've done, right? We've done 365 crores all offices. We are also targeting warehouses. We are also targeting hospitals. We are targeting data centers also. Anything non-residential, which makes sense, Yash, because it's not about entry only. It's actually about exit.
Yeah.
When are you able to exit and at what IRR? And every time we give an info memo to an investor, it clearly indicates what the IRR is we expect on exit.
Okay.
So we look at any asset class other than resi, but depending on where we can exit and at what IRR. And if it makes sense, we'll do it.
Okay. Fair enough. And are you focusing primarily on tier 1 cities right now? Or you're open to going to tier 2, tier 3 cities as well if the opportunities right?
We are open to do tier 2 cities also. Presently, because the tier 1 opportunities are a lot. So we are focused on it, whether it's Pune, whether it's Bangalore, whether it's Mumbai. But we are very open around tier 2 cities. And so a lot of our investors come from tier 2 cities.
Got it.
Yeah, I think the one thing I would say, Yash, is it's a very secure instrument for investors. And the SPV we create right now, it's a bankruptcy remote vehicle.
Yeah.
So it doesn't matter what happens to hBits.
Right.
We are just the asset manager. So the investor has always got a real asset backing that AAA rental yield which he's getting.
Perfect.
So it's so security wise, it's very, very good for the investor.
Agreed. And as hBits, because you're the investment managers of that property, what kind of management fees or other fees that we charge?
We charge 1% per annum management fees.
That's fair.
And then on exit, we charge typically 15% over 10% hurdle rate.
Okay. Okay. So it's just like an EIF for something like a wealth manager who is running a PNS side of structure.
Exactly.
Perfect.
And we also want to, make money for the investors so that we can charge our fee. If we don't make that money, what's the point for them? Yeah.
No, the interests are aligned, and that's what has
Yes.
worked in the asset management industry also for a long, long time.
Absolutely.
Great, Samir. I will just finish with one last question. Because you talked about 65 to 70% of your portfolio is in property, I'm very curious to know what other 35% comprises of.
So I would say 25% of that is in equities.
Right. Indian equities or global equities?
Indian and global.
Global. Okay.
More global, I would say.
Okay.
And rest 5% is in commodity, in precious metals.
Oh, wow. Okay. So, and nothing on the other alternatives side, right? Like private equity or AIS or something like that.
It's there, I would say, in private equity, but it's a small proportion.
Right.
I mean, it's less than 5%, so that's why I didn't say it.
Right. Okay. Got it. Great. Thank you so much, Samir. Learned a lot today. I mean, I'm very ignorant about this area, to be very honest, but because I don't understand property real estate very well, like you said, it needs a lot of domain knowledge to really understand the market. And while talking to him, I'm 100% sure you've got that. So thank you so much for coming to this podcast. Really, really loved having you. Thank you.
Thank you, Yash. Thank you so much.